So, we've just released our results for the financial year ended June 2025, and I think they've really been marked by a significant increase in the optimism in the real estate market. We've seen a really nice uplift in our valuations of a like-for-like of about 6.5%, and I think that's driven by the sentiment in the market and a lot more direct deals that we're seeing. So our sales and acquisitions team are getting a lot more inquiries from interested buyers on the assets that we deem non-core. And I think we've had yet another successful year. We've sold about 1.4 billion rands worth of non-core assets at about a 3% premium to our previous book value, which I think is indicative of, firstly, the conservative valuations in our books of our assets, but also that there's a market for these smaller assets that we deem non-core. And part of the cycle that we've been on with our big development pipeline at Fortress of a lot of these logistics warehouses has been to sell those assets and to keep building our big logistics boxes. So as we sit here today, we've got almost 23 billion rand invested in the logistics sector. Most of that is in South Africa, but we also have a significant investment in Central and Eastern Europe, mostly in Poland, of now about 5 billion rand. So that's been a significant shift in our logistics business, but it's really still SA focused, and we still have a relatively large pipeline of about 150,000 square meters in South Africa. So when you look at our balance sheet at the end of June, the assets are primarily 23 billion rand in logistics assets, and what we mean by logistics is really prime warehouses, like the Pick n Pay distribution center that we built at Eastport and assets like that. That's 23 billion. We then also have a 12 billion rand retail portfolio, which is, for this current year, a standout performer. Vuso Majija, our retail executive, and his team have done a really fantastic job. They've grown the like-for-like net operating income of that portfolio 9.4% from last year. So I think that's an extremely impressive performance when inflation is sitting at between 3 and 4%. We do have some other assets which we deem non-core in the industrial and office sectors. Fortunately, our offices are now under 1.5% of our total assets. I think the sales team has done a great job of getting rid of those assets at premiums to our book value. So that's really the direct portfolio that we've got, totaling 37 billion rand of direct real estate. Alongside that is also significant investment in the largest listed property counter on the JSE, called Nepi Rockcastle, which is also based in 8 Central Eastern European countries. They have a portfolio of just over 8 billion euros now, so a staggeringly large retail specialist fund in which we own just over 15%. They came out yet again with really great numbers, forecasting dividend growth there of about 3%. We've got about 15.5 billion rand invested in that. So Fortress as an investment proposition, I think, is looking really good. We've delivered a total return to our shareholders in excess of 30% over the last year, which I think has really been, a closing of our discount to NAV, and then just good performance from our underlying portfolio, which we've worked quite hard at over the years in terms of increasing the quality and the earnings growth in terms of the new assets. So I think all in all, we're very proud of the financial results that we've presented and we've delivered for this year. And I think the shareholders have acknowledged that, and the price has been quite buoyant.
We're really pleased with the financial results of the 2025 June year end. We've had exceptional growth in the current year. Our year-on-year distributable earnings is up just around 9%. Our second half earnings up 23%, delivering a dividend in the second half of 86.29 cents per share. As we have done in the past and continue to focus on total shareholder return, we are giving shareholders an option to take up their dividend either in cash or in the form of a Nepi share at a slight premium, at about 10% on price.
When we look at the overall market, I think it's been a very positive market, stemming from really the GNU last year and then the reduction in interest rates. So we have seen a lot of the listed property counters also start to rally, and I think it's with a lot of cautious optimism that we look at the South African Reserve Bank and their interactions with Treasury to see if we can get that inflation target down to 3%. It's a strange one for us. Real estate does like a bit of inflation, but if we can get that to a lower level, then our borrowing costs are going to come down and our distribution to our shareholders is going to increase. We do pay out a regular dividend. So I think something that we often engage with our shareholders on a regular basis, and I think something that's sometimes missed, is we aren't a REIT. So a lot of the listed property counters are REITs, which are real estate investment trusts, which pay out a taxable dividend, but the company doesn't pay tax. We're a bit different. We have a lot of tax shields, which fortunately our CFO, Vorster, and the team have managed to utilize to the maximum benefit. So we actually have quite a low effective tax rate. So at the moment, we're not looking to become a REIT again, but the advantage for tax sensitive investors, for individual investors, that we do pay out a vanilla dividend, so the company pays the tax and investors then get an after-tax dividend.
A couple of highlights that are worth noting in the current financial year is the growth that we've seen in the NOI coming from our direct portfolio, and this is really aligns with our strategy of rotating out of the old sort of industrial and offices and into our new big box logistics. That NOI growth has come through, and it does filter through to our distributable earnings. I think we've seen between 12 and 8% year-on-year growth, which historically has only come from the developments. Distributable earnings growth year-on-year is also driven by the reduction in interest rates that we've seen in the last year, and we've followed a particular strategy with regards our interest rate protection, where we favoured a cap product over a swap product, in which that allows us to share in the benefit of any interest rate reductions. And with the rates coming in, that benefit obviously falls to the bottom line and can be delivered to our shareholders in the form of distribution. Along with this strong operational performance for the current year, we've been able to revise our guidance for 2026. We did have a number out in June when we did our pre-close, where we guided roughly 6 to 7.5% on the then forecast earnings for the year, which we have now exceeded by circa 25 million. So we've been able to re-guide our forecast, or re-guide still at 6 to 7.5%, but to a number of closer to 2.1 billion for 2026.
I think the business is in very good shape. All of the subsectors seem to be doing better, and the overall market is a lot more optimistic. The logistics vacancy is at almost 0%. There is a little bit of vacancy, but the record lows that we're seeing have really precipitated a slightly harder stance from a landlord perspective in terms of asking rentals. That's also been assisted by the significant rise over the last couple of years in construction costs. So when we're building new warehouses, if it's going to cost us more, we have to somehow balance that with a higher asking rental from the tenants. And I think what we were concerned with many years ago is you had these high escalation rates, and then when the lease came up for renewal, you'd get what we call a negative reversion. So the rental would come down, for example, from 100 Rand to 80 Rand, and that would be a negative reversion of 20%. What we've seen for this current financial year is that overall on our whole portfolio, we actually have positive reversions for the first time in a while. And I think what that means is that the contractual escalations which we embed in the leases of between 6 and 8% is actually keeping track with the market rentals. And I think that's a very, very positive signal for us, that we're able to build new buildings and we're able to get the rentals on the old buildings that we're asking on the new buildings. And that's been really positive for the whole of the South African property market, but in particular the logistics and industrial space, where we're getting these nice rental uplifts. It's also important for our development business. We currently have about 140,000 square meters under construction, and for the first time in our history, our pipeline in Eastern Europe is marginally bigger than our pipeline in South Africa. So that's a significant growth vector for us. It's been an interesting market to get involved in, and I think we're still very, very positive on our own business there, as well as the business of Nepi Rockcastle in Central and Eastern Europe. So I think all in all, a set of results we can be proud of, and I hope that we can deliver on the optimistic guidance into our financial year to June 2026.